If you often feel that your income isn't enough or disappears too quickly without realizing the root cause, then you need to understand how time impacts earned income compared to invested money. While wages are limited by time and effort, investments can grow over time, creating a disconnect that leaves many individuals stuck in a cycle of earning without building lasting wealth. So in this video, I'm going to show you how time affects your paycheck, how compounding works underneath all the chaos, and the list of Fidelity funds that keep growing even when the economy feels unpredictable. And at the end, I'll walk you through how a Fidelity Index portfolio can make you a millionaire just by investing $8.57 per day or $60 per week. But first, let's try to understand why investing weekly tends to outperform a single lump sum deposit in real-world scenarios. Many people shy away from weekly investing because the amounts seem too small to matter. Putting in $5 or $10 can feel insignificant, but that hesitation often stems from the ongoing financial strain people face every day. When costs rise faster than income, it's not the size of the investment that makes the difference. It's the consistency that steadily works in your favor. You can see it clearly with something as basic as food. According to USDA Food Price Outlook report, since 2020, food prices increased by 3.5%, then 3.94%, then 9.9% in 2022. They slowed down a little bit but still increased by 5% in 2023, by 2.3% in 2024, and by 2.9% in 2025. And in 2026, world food prices are projected to rise 3.6%. In order to make you understand in simple terms, groceries that cost $20 in 2020 now cost about $26.22 in 2026. That's the kind of change you don't just see, you feel it every time you're at the checkout. Meanwhile, borrowing has become much pricier. Data from the Federal Reserve shows interest rates climbing from 0.25% in 2020 to roughly 3.78% by mid-2026, making mortgages, car loans, and credit card payments increasingly burdensome month after month. And while costs rise quickly, wages have not kept up. According to the Bank of America Institute 2026 Employment Report, payrolls growth accelerated to 1.3% year over year in February 2026. This is barely keeping up with short-term inflation and nowhere close to the total rise in prices we have seen since 2020. Then there's the stock market. Looking at a long-term timeline of crashes from the Great Depression to the dot-com collapse, the 2008 financial crisis, the COVID-19 market crash, and inflation-driven downturn in 2020, you can see how severe each drop felt in the moment. But the charts also reveal something important. Every major decline has eventually recovered and the broader trend continues upward. Over time, the market has consistently delivered average annual returns of about 10 to 11%, including dividends. That's what makes steady weekly investing so effective. There's no need to predict inflation, pick market peaks, or perfectly timed downturns. When prices go up, you're still contributing. When they fall, you're buying at lower prices, and when the market recovers, you're already positioned to benefit. In a world that constantly shifts, that steady little habit becomes one of the few financial moves you can rely on. And this is where the title of this video connects directly to real life. Because when the average paycheck grows around 1.3% a year, but a long-term portfolio often grows 5 to 6 times faster, your investments begin to build towards something your salary can never reach, eventually making you a millionaire if you stay consistent long enough. Looking at those numbers, it's easy to see why long-term habits matter. But here's what most people overlook. Even small weekly contributions can create a much bigger snowball effect than you would expect. The snowball effect becomes clear when you look at how even small weekly investing behaves in the first few years. Imagine someone putting in $20 every week. That's $1,040 per year. An amount so small most people barely think about it. In year one, the contribution is $1,040, and with normal market growth and reinvested dividends, the balance starts to move a little bit. Nothing dramatic yet, but the base of the snowball is forming. By year 3, total contributions reach $3,120, and with dividends reinvested and those early deposits getting time to grow, the balance could sit around $3,459. That extra amount, the part that did not come from contributions, is the snowball starting to build. By year 5, total contributions reach $5,200, but the account may be closer to $6,413. Now the snowball has real weight. Each weekly deposit lands on a larger foundation, and every dividend buys more small pieces of ownership that create even more dividends. The first 5 years don't look explosive, but they build the groundwork that makes long-term growth possible. And at the end, I'll show you a Fidelity Index portfolio, and how the snowball effect can turn a $60 weekly investment into a portfolio worth a little over $1 million, making you a millionaire. Understanding how the snowball builds is only part of the picture. The mindset driving it is just as important. Most people don't struggle with weekly investing because it's complex. They struggle because the early results feel too small to matter. You put in $20, then you see only a slight change, and your brain immediately wants to judge the process. We are used to expecting quick wins, so when growth appears slow, it's easy to assume nothing's working. On top of that, short-term market swings trigger emotional reactions. In reality, compounding doesn't grow in a straight line, it moves in curves. Markets rise, fall, and fluctuate along the way, and early on, that progress is hard to see. The real shift happens when you stop measuring success week by week and start focusing on consistency instead. Rather than asking, is this growing fast enough? The better question becomes, did I invest this week? That simple change removes the pressure for immediate results and replaces it with a habit you can control. Over time, that consistency is what allows your portfolio to outgrow your paycheck, not because you outsmarted the market, but because you stayed disciplined long enough for compounding to do the heavy lifting. Once you adopt that mindset, picking long-term investments becomes much simpler. Instead of chasing the perfect investment or stock, it's more effective to focus on qualities that support stability and long-term growth. The same principles that make the Fidelity funds in this portfolio work so well together. So the first is diversification, which means spreading your investments across many companies so no single failure has a major impact. By owning a broad mix, often through index funds, you reduce risk and achieve more stable, steady growth without needing to pick individual winners. The second is broad exposure, which is about the types of companies in your portfolio, not just how many you own. Since different categories like large caps, mid caps, or certain sectors perform better at different times, a solid long-term portfolio spreads investments across sizes, sectors, and styles to stay balanced through market shift. Next is real historical performance. You want investments backed by companies that have grown their earnings over the years, not hype circles. Dividend growth is another key ingredient. When companies raise their dividends yearly, those increasing payouts buy more shares and make the compounding look stronger. And finally, low fees matter. Even small fees add up over decades. So low and zero fee funds keep more of your returns working for you. When you put all these criteria together, you end up with a portfolio built to handle downturns, capture long-term growth, and compound steadily as time goes on. And that's exactly where these 5 Fidelity funds stand out, because each meets this criteria, and together they provide the diversification and balance needed for a strong, well-rounded portfolio. The first one is FZROX, the Fidelity Zero Total Market Index Fund. This is the core of your portfolio. A simple broad market fund that owns large, mid, and small cap companies across every major US sector. Its purpose is to track the entire US stock market with zero management fees. Since the fund's inception, the average annual return has been 13.83%. Then there's FSMDX, the Fidelity Mid Cap Index Fund. Instead of focusing on the biggest companies, this fund invests in mid-sized businesses that are stable enough to be reliable but still small enough to grow quickly. It typically holds around 300 companies spread across tech, industrials, consumer sectors, and finance. Since the fund's inception, the average annual return has been 12.46%. Next is FITLX, the Fidelity US Sustainability Index Fund. It invests in companies screened for strong environmental, social, and governance practices, including many leaders in tech, healthcare, and communications. It's built for steady appreciation with exposure to companies shaping the future. Since its inception, the average annual return has been 15.03%. Fourth is FGRIX, the Fidelity Growth and Income Portfolio. It invests mostly in high-quality large-cap companies with stable earnings, giving you a mix of reliable dividend payers and consistent growers. It offers dependable income without giving up growth. Since its inception, the average annual return has been 10.44%. Finally, FDGFX, the Fidelity Dividend Growth Fund, which focuses on companies with long histories of raising dividends and strong financial fundamentals. It leans towards safety and consistency rather than aggressive growth, which helps steady the portfolio when markets cool off. Since its inception, the average annual return has been 10.26%. Now, since we're treating each fund as an equal slice of the portfolio in this simple example, if we divide the total of 5 funds' average annual return by 5, the number of index funds in our portfolio, we get 12.40 average annual return, which includes share price appreciation, capital gains, and dividends. contributing to a fund's overall return. To simplify, we'll use this to help measure the fund's long-term performance. So let's take those strengths and see what they turn into over time with real projections. So let's take an example. Let's say you are contributing $8.57 per day, which adds up to $60 per week. And because the portfolio has 5 funds, that's basically $1.07 going into each fund every day. It's a tiny amount, the kind of money most people spend without thinking. But for most people, showing up with that small daily habit is what turns it into something meaningful. By the end of year 1, your total contributions would be about $3,120. This lays the groundwork for future growth and compounding. By year 10, the portfolio is projected to reach $61,658 with reinvested dividends starting to build real momentum. By year 20, you would have contributed $62,400 in total, and the long-term compounding will push your portfolio to about $274,411, generating nearly 14 grants per year for you. The final decade is where compounding really shows its strength. By year 30, your portfolio is projected to reach $1,008,516, and once you reach the 30-year mark, the breakdown will become even clearer. Over those 3 decades, you will have contributed a total of $93,600 out of your own pocket, but your portfolio multiplied it by almost 11 times to $1,008,516. Out of that future $1,008,516, subtracting your $93,600 in contributions leaves roughly $914,916 created entirely by compounding, reinvested dividends, and decades of steady market growth. That means the vast majority of your future wealth won't come from what you paid in. It will come from the portfolio working for you quietly and automatically without you doing almost nothing. And that's the point where your investments will make you a millionaire. All because you stayed consistent with a tiny daily amount. I hope this video is helpful. Please don't forget to share and subscribe, and I'll see you in my next one. Thank you.